Thank you, everybody, for making some time for us today. I'm Jim Denholm, founder and CEO of Ironbridge Private Wealth in Austin, Texas. This is our strategic growth webinar series. And obviously, we've had a little bit of market volatility over the last few days and wanted to schedule a time where we can go over some of that, talk about some different scenarios, but most importantly, answer questions that any of y'all might have. We're going to be doing the questions through the chat format. So if you look across probably the bottom of your screen, there's a little chat icon. If you click on that, Whitney Barker is going to be monitoring the chat. So I think the most important part of this is going to be able to answer questions that y'all have. So please don't hesitate to use that chat function throughout the presentation. I'll try to get through the actual presentation part of this relatively quickly, maybe 10 to 15 minutes, and then answer questions throughout. I'd be happy to answer some questions that you have along the way. And then there's obviously going to be some time at the end that we're going to spend just purely answering questions. So we're really going to just jump right into it. What we're looking at basically is the Silicon Valley Bank failure a contained scenario, or is there risk of contagion? So we'll look at each of those kind of pros and cons of each. We'll talk briefly about the macro, kind of there's some bearish things starting to pile up. We're going to look at the bearish versus bullish data. We're going to look at the S&P 500 and also look at the 2-year Treasury is kind of doing some weird things. And then we'll look at current portfolio positioning for our clients, and maybe as a guide if you're not a client of ours. So we're just going to jump right into it. If we look at a contained scenario, the thought process is that the issues that Silicon Valley Bank dealt with is an outlier. It is bank specific, and it's not a symptom of a larger problem. So one of the ways we want to look at this is say kind of how widespread is the market volatility in the banking sector. So what we did is obviously Silicon Valley Bank is zero now. So it's in receivership. The stock is no longer traded. First Republic is kind of starting to be the next. There was also a Signature Bank in New York that was taken over that also went under. First Republic is, kind of what the market is starting to say might be the next kind of domino to fall. But when we look across the overall banking sector, and this is about over the last month, this is stock price over the last month or so. JP Morgan is down less than 10%. Wells Fargo down 21%. This is the regional bank index. So it's excluding the bigger banks. It's excluding the Goldman Sachs and things like that. It's just purely looking at the regional banks. It's down 30% over the last month. Most of that obviously in the last week. Credit Suisse is down about 36% over the last month. That's down a whole lot more if you look longer term. Credit Suisse is looks like it could be one of the next ones to fall. But if you look, obviously there's a handful of these banks that are down 70 or 80%. Being down 30% for the overall regional bank index is not good, but it also isn't signaling necessarily that there's dozens and dozens of regional banks that are at risk of failure. So it's bad, but it's because it's not as bad as some of these others, it could be considered good. Let's look at another kind of broader look at the overall market. Technology and communication services are holding up pretty well. This is the overall market over the last month or so. And we've got some of these bigger areas of the market that are holding up fairly well. I mean, tech and communication down 4%. Overall S&P down almost 7%. Industrials and consumer discretionary down 7 to 8%. And then you've got energy, and then broader financials. This is the S&P 500 financials So this includes the bigger banks. This includes Morgan Stanley, Goldman Sachs, those other kind of brokerage firms as well. Those are down 15, 16%, but it's nowhere like these regional banks down 30. So one of the things that is a positive is we've started to see some of this contagion happen in the really tiny banks. It has happened a little bit more broadly in these regional banks, but we haven't necessarily seen a lot of damage to the overall market. So that is a positive, at least for now. So there are some real signs that maybe this was a Silicon Valley Bank issue. Maybe this was something that their risk management team should have done, and they should have managed their risk a little bit better. So there are some scenarios that argue that it could stay contained. However, if we look at the contagion scenario, what we went through and did is say, okay, what more broadly are these unrealized losses in these reserve accounts that Silicon Valley Bank had to deal with? Is that isolated to Silicon Valley Bank, or is that a more broad issue? Unfortunately, that is a more broad issue. So the theory here is a contagion theory is that because of the Fed's actions really since 2008 and 2009, that they have created this environment where by keeping interest rates extremely low for so long, banks had to go out and with excess reserves invest in what were perceived as safe securities, treasuries, mortgage-backed securities, these different bonds that they want to be able to hold it to maturity. And we can see this is a chart of the entire U.S. banking sector in billions of dollars. Gains or losses in these held to maturity securities or available for sale securities. And the way to think about that as a bank, when they have reserves that they're keeping on hand to address customer withdrawal requests, there's essentially three buckets. There's a kind of an operational cash account. There's this available for sale bucket. That's a short-term portfolio of bonds that they are marking to market. So as prices of those bonds fluctuate, they're reporting the value of that each month or each quarter as the actual market value. And then there's this sort of long-term reserve account that is not anticipated to be used. So those are investments that are held at the maturity value. So if they put $1 million or more like $1 billion in a bond, and that bond price falls 20%, there's a $200 million loss in those bonds. They reported on their balance sheet as $1 billion when it's put in this held to maturity bucket. So what we've seen is that there are $620 billion of unrealized losses across the banking sector. This does not look like it was a Silicon Valley Bank issue. The narrative at first was that Silicon Valley Bank had poor risk management and they didn't manage their interest rate risk very well. Well, I don't think that they're alone. Now, so it looks like the Fed has created this environment where there are other banks at risk if deposits start to flee. The real concern, obviously, smaller banks are an important part of the U.S. economy. What we wanted to do next is then look at the big banks. So if we look at the four largest banks, how have they done with managing this interest rate risk on their reserves? Well, the four largest banks, Bank of America, JP Morgan, Citi, and Wells Fargo, have a combined $250 billion of unrealized losses in their available for sale and held to maturity portfolios. So that's kind of a scary number. There's two ways to think about that. One is that, yeah, there's a lot of unrealized losses there, but it doesn't matter unless deposits leave. If Silicon Valley Bank didn't have a real bank run on its hands, the fact that they had unrealized losses would not have mattered. So when we look at the large banks, these are the systemically important banks where if we saw one of these fall, we're talking real problems in the economy and really, really big problems in the markets. But it doesn't matter unless those deposits leave. Banks have a requirement that they have to keep 10% of total deposits on reserve in either their cash account, they're available for sale, or they're hold to maturity. So 10% of their total deposits have to stay in those reserves. So, right now we're seeing these four banks be giant beneficiaries of the volatility in the smaller banks, in the regional banks. There are a lot of companies and a lot of individuals that are shifting their funds from Regions and Key Bank and Horizon Bank and these smaller banks into the JP Morgan, Bank of America, Citi, Wells Fargo. So, they're getting inflows right now. So we shouldn't expect a bank run to necessarily happen on these big banks. The problem in this environment is that a bank run may not be just people lining up to take cash out. We're seeing an environment where interest rates on savings accounts are paying 0.5%, maybe 1%. Maybe you can get lucky and get a 2 or 3%. Well, money market funds are paying 4.5%. 6-month treasuries are paying 4.5% to 5%. So, all a bank run on the bigger banks is something that we need to keep in mind, is that it might not be people waiting in line to get their deposits out. It could be that they're calling their relationship manager and saying, hey, I've got $10 million there. I want you to put 9.5 million into a 6-month treasury. So they're not closing their account. They're not withdrawing their funds. They're just saying, go put me in something with higher interest rates. That's the same thing with regards to a bank. They might as well have come and gotten cash and taken it out. So there's some dynamics that we have to watch here, that we need to be paying attention, because from a risk management standpoint, this was not necessarily isolated to Silicon Valley Bank. Going to shift. Feel free to put any questions that you have out there. Happy to answer those as we go along. We're going to do that via the chat function. So let's take a turn over here to the macro discussion. This is kind of a pros and cons, what's in the bearish camp, what's in the bullish camp. We've shared this over the last probably 6 or 8 months. And frankly, right now, the bearish data is starting to pile up. We've got bank failures now. Lending has been drying up over the last few months. There's been a change in banks' willingness to lend. The last few days of bank failures is not going to help that by any means. The overall money supply, as it relates to M2, is shrinking for the first time in about 70 years. The Fed is really in a pickle right now. A week ago, before all this started happening, there was an 80% likelihood that the Fed was going to increase 50 basis points at their meeting next Wednesday. Now it's basically 50-50, whether it's going to be a 0% if they're not going to raise, or if they're going to do a 1/4 point raise. So the Fed is in a hard spot right now. We're seeing earnings decline. We've got inflation that's persistent but starting to weaken. Economy's weakening. Housing is weakening. The consumer is stretched. War and debt ceiling are more political issues that don't tend to have lasting effects on the market, but we're really starting to see the lists of things that are, a little bit more negative start to pile up. Bullish data, inflation is easing. The consumer is still pretty resilient. People are traveling. People are going out to eat. So there's still spending in the economy. The U.S. is a consumer-based economy. About 70% of GDP is the consumer. So that's not a minor bullish data. And really, most importantly, the market is flat. It's flat for the year. It's had some volatility recently, but we haven't seen a big, thrust lower in markets. And when we've got all these bad things, when the market is ignoring reasons to go down, that can be a pretty big positive. So it doesn't say that it's not going to, but it hasn't thus far, and that frankly is a fairly good sign. So let's look at the S&P 500. We've had this consistent downtrend from the high point last year. We broke above this earlier this year, and we're just in this range. And frankly, the S&P 500 is just kind of messy right now. But while there hasn't been a lot of constructive things happen in the market, we also haven't seen a real, heavy move lower. So that's a positive. If it's going to stay in this range, it could just easily weather this storm over time. I think it keeps a lid on what the future market prospects are. But if it can stay in this range, I think that's a net positive. One warning sign, looking at the macro discussion, is Treasury yields. So there's a common saying that the Treasury market is the smarter market. We saw a 2-day change. What this chart is it looks at 2-day changes in the 2-year Treasury. And we've now had the second largest decline in the 2-year Treasury yields over the last 40 years. It goes back a lot further. But this drop was about 85 basis points that the Treasury yields fell over 2 days. That's bigger than when Lehman Brothers collapsed in 2008. It's bigger than when the market opened after September 11th. And it's not quite as big as the 25% one-day drop in the S&P 500 in 1987. So the stock market has been holding up pretty well. The Treasury market is signaling trouble. And these are things that we just can't ignore. So looking at positioning, current client positioning, what we look at here is our balanced strategy, a growth strategy, aggressive growth strategy. The blue is the maximum equity exposure in the portfolio if things are good. And the gold is the current net equity exposure. We have some long positions and we have some hedge positions, the inverse ETFs that go up if the market goes down. And right now we're way underweight risk. I could see this drop even further. But we're in a very defensive position. We own a lot of shorter term treasuries, cash equivalents. We have bought some longer term treasuries over the past few days for clients. But the net yield on cash on the sideline is about 4.6%. So it's nice to be able to get paid while we wait. But we're very defensively positioned. I think clients can get comfort in the last few days if you're looking at your portfolio at the end of the day that it's really not moving very much, and that's good. I know there was a point at one point this morning where the Dow was down 600 or 700 points and client portfolios were flat to slightly higher. So being defensive right now, I think, is definitely the course of action. I think there's pretty low opportunity cost to miss out on a really big bull market. If a bull market comes out of this, that'd be great, and we'd be happy to miss the first leg of it. But right now, with the risks really piling up, I think by far the most prudent action is to get out of the way, because it's hard to imagine that we have a banking crisis that lasted 2 days with all these bearish things that are starting to happen. So with that, I'd like to open it up to questions. I know there's a lot of things going on right now, so if you want to use the chat function, we can do that. Excuse me, do that right now. So we'll let people kind of type in some questions if you have any. Nobody? Okay. Speak now or forever hold your peace. Looks like we got one. If you want to type it, if you could type it into the chat, that would be the best way to handle it. Instead of putting you on camera. Okay, let's see here. Looks like we might have a. There we go. Look, it's in the Q&A. Curious if regional banks can do anything in the short term to offset their current exposure on their losses. There's a few different ways that they can address. You know, if banks get have to meet deposit. This is a really good question too. If banks have to meet fleeing deposit requests, there are a couple different ways that they can do it. They can use their reserves. You know, they can use the cash on hand. They can use the short term on hand. They can use the long term on hand. They can raise capital. So Wells Fargo, for example, went to the market and raised $10 billion yesterday. They can sometimes, when they raise capital like that, that can sometimes be perceived as a desperation measure. But they don't necessarily have to just have growth. They can try to attract deposits there. They can attract cash in the form of debt that they offer. They can attract reserves by offering equity, you know, shares of stock. That takes a little bit longer to go through the process. They can do, you know, short-term loans. They can do various ways to raise cash to increase their reserves as these, to meet these withdrawals that can hopefully get them to a point of saying, hey, don't worry, you know, it's a confidence thing essentially. As soon as they can kind of keep that confidence back, they can do things not necessarily to increase profits, or decrease the losses, but they can raise funds. The other thing, when we look at this, Treasury yields decline, the Treasury yields declining. When yields go down on fixed income, prices go up. So if the Fed were to go in and stop raising rates or even cut rates, that would naturally reduce this $620 billion of unrealized losses. So this is where the Fed is kind of in this pickle. So as the bond prices go back up, that naturally increases their reserves by the Fed pushing down interest rates. So it's something to really watch that. Okay, we've got a few questions here, which is great. So one question is a follow-up to this, and then I'll answer a couple of the other things that are in there. Interest rates stay at this level, exposure isn't going to change. Yep. So basically, comment being, you know, if interest rates do stay at this level, there's not a lot that they can do right here. So, you know, there continuous shocks to the system with a run on another bank, 3 months, 6 months, 12 months down the road, you know, something happens where something spooks depositors and you see another run. Absolutely. That is a huge risk. The contagion scenario is very, very, it can be a bad scenario. And there's if the Fed didn't keep interest rates at zero for so long, print so much money, that eventually with COVID caused inflation and then had to have this massive increase in interest rates, we wouldn't be talking about a $620 billion hole in banks' balance sheet. So a little soapbox talk. The Fed's job is to promote financial stability. I think they have created financial instability. So there is fragility in this system. So couple other questions here. What's the next market we're watching? Credit Suisse. I mean, we've been telling clients this for about 6-8 months, that Credit Suisse is the big one that could potentially cause a problem. I'll go in and just show you if you can see this chart. I'm going to go back a weekly chart. This is Credit Suisse stock. It peaked at $80 a share in 2007, and it's at $2 a share today. This is a slow motion bankruptcy. But Credit Suisse is about 4 times as big as Lehman. So it's much more connected globally than these smaller banks. And that's the risk. If you get a bigger institution that has tentacles, if that were to fail, you have real contagion. And that's where you see kind of a 2008 kind of an environment. Another question, are you moving more into money market funds and out of what, equities or bonds? So when we look at the positioning, we've been moving out of equities pretty consistently, but this is not a new thing. We've been pretty underweight equities for about 9 months right now. We've had some increase, some decrease. The recent decrease was out of equities into shorter term cash equivalents, kind of money market like positions. Over the last week, we've started to extend duration a little bit because if interest rates do go down, you can get some bonds, especially Treasury bonds, can be very attractive because not only do you get the yield as you hold those, you can also get appreciation. So we started to see, we've started to move out the duration of the yield curve, where we were staying kind of 1 to 3 months at the most in maturity with these various kind of cash equivalent ETFs. We have started to go into a 1 to 3 year. We've got a 7 to 10 year treasury that we put in the portfolio last week. So we're extending that duration a little bit because you want interest rate sensitivity if interest rates are flat to lower. If this problem of unrealized losses on fixed income is because they had interest rate risk when interest rates were 0 and they went up to 4.5%. Well, if interest rates are at 5% and they go down to 3%, interest rate risk is good. So we've been avoiding interest rate risk really since we've been at Ironbridge, and longer than that. I mean, with interest rates at 0, there's no benefit to taking interest rate risk. So we've been extremely short term. Now it makes sense to extend duration a little bit. And I think we're going to continue to do that as we get signals to do that. But we're starting out in kind of the belly of the curve, sort of the 3 to 10 year part of the curve. The long end of the curve, the 20 plus year maturities can really get volatile. But it's a pretty attractive opportunity with treasuries in that kind of 3 to 10 year space right now. So we've been moving out of equities, out of more corporate bonds, and into treasuries of various maturities. Another question, what would be an indicator to watch that things are improving? A few things that we'd look at. One is the market itself. There's sort of a few different ways that you can view the stock market. You can view it as very short-term, emotional, kind of a voting machine that can be subject to these whippy kind of news announcements. But the market, another way to view the market is that it is a visual representation of some of the smartest people in the world putting their capital at risk in anticipation of certain things happening. So in one way, the stock market could be the best indicator to watch. It's probably going to move before some macro things happen. For example, if we look, it's a more extreme example in 2008 because we know how that story ended. We don't know how this story ends just yet. But if we look at 2008, the peak of the stock market in 2007 was the economy was pretty fantastic. So there was not a lot of reasons for the market to start heading lower. There were some warning signs, but the market started heading lower before the fundamental data started to change. So when things are fantastic is typically when markets peak. In March 2009, when markets bottomed, there was nothing to be optimistic about. That the economy was in shambles. There was immense uncertainty. Unemployment was through the roof, and stocks bottomed and started to move higher because some of the smartest people in the world, risking their own hard-earned capital, decided it was time to buy. And you had more people selling. You finally exhausted all the sellers, and people started to come in and buy. So, the market is kind of crazy over the short term. It's very crazy over the, hourly and daily and sometimes weekly. But if you zoom out, the market can be a fantastic indicator. A couple other things that are a little bit more in the weeds to look at: credit default swaps. So if you look at credit default swaps, that's people betting whether a company is going to go bankrupt or not. Credit Suisse basically has about a 70% likelihood of failure if you look at their credit default swaps. So there are, the yield curve we've watched, leading economic indicators we've watched. But when it comes to the immediate banking crisis, the markets are going to be one place to look, and the credit default swaps are going to be another place to look. Really good questions, by the way. Looks like we have one more question. Is today's environment potentially as disastrous as the 2008 financial crisis? Potentially, yes. I don't think there's really any kind of question about it. Let me see if I can find a chart real quick on another screen and open it up. Saw this a little earlier. I don't know if you can see this very well. I'll zoom in. So somebody shared this on a little market group that I'm on in Twitter. If this is 2008, I've kind of zoomed in here. So if we look at the dates here, this is a chart of the S&P 500 going back to 2003 all the way to the current day. There was a lot of bad stuff that was happening before we got to October. And October is really when things started just going haywire. We had the Fed was cutting rates up here kind of at the top. Bear Stearns went under. The Treasury did this term auction facility, which is kind of what the Fed did last week. They created a fund to support depositors in Silicon Valley Bank that were above the FDIC limit. This is basically what they did in 2008. You then had IndyMac fail, was a bank. Freddie and Fannie failed. And all of this was happening, and there was about an 18% decline in the overall market. Then you had you had Lehman and Washington Mutual go under. You should have had Wachovia, should have had a lot more. AIG went under. They started TARP, which just kind of brings back bad memories. We had Madoff. Merrill Lynch was acquired by Bank of America for $1. And then the Fed started QE, and we kind of went off to the races. Well, we're kind of going through a similar cadence here. We had the Silvergate, Silicon Valley Bank, Signature, First Republic. Looks like they're next. We had this basically slush fund that the Fed created to backstop depositors. Credit Suisse could be next. ECB may hike rates. So the conditions are there for some bad stuff to happen. And when we look at the bearish data that's piling up, the yield curve, the leading economic indicators, the analogy that I like to make, and we're probably going to do this in a report. I've told clients on a one-off basis that one of my superpowers is that I can make really terrible analogies. And the way I think about this is that there is the potential of an economic and market hurricane. The conditions exist right now. That doesn't mean that the eye of the hurricane is going to hit us. It might rain a lot. We might have the eye of the hurricane hit us, but it could just rain. It could, sprinkle, and it might just completely veer off and go somewhere else. And it's something that we don't have to worry about. But the conditions exist for bad things to happen. And if bad things do happen, it is going to be, and you haven't taken the steps to address it, it's very, very irresponsible, because there's so many indications that bad things can happen. Banks don't go under in bull markets. We don't have volatility like this in the Treasury market in bull markets. We don't have money supply shrinking in bull markets. We don't have earnings declining and housing being weak and all these different things. They're bear market behaviors and they're bear market indicators. The market itself, we're still seeing support in the overall market. So at the end of the day, what matters to your portfolio is the closing value of what you own. And, I think we're going to see bear market rallies. And I think it's really important to stay very objective in times like this. It's easy to get emotional, and being emotional is when mistakes happen. And you can get emotional in a couple different ways. We could see these bull market, a rally that we don't know at the time if it's going to just continue going up this 45-degree angle to new highs. But it's easy to think that you're missing out right here. It's easy to panic and capitulate right here. So, we really need to look across data. It's why we have our system set up like we do. We want to be data dependent and look at things in a lot of different ways. But when we look across the board, unfortunately, a bull market looks like it's a pretty low likelihood. And, as a wealth manager, we want markets to go up, but because we can be tactical, I think we can look at things a little bit more objectively and really consistently since about over here, May, June timeframe last year, our signals have told us to really be very underweight equities. And that looked great here. It looked terrible when the market rallied here. It looked fantastic here. It looked stupid here, and it's looking great here. But overall, the market is in this choppy sideways. So I don't think that I think that we're going to be in one of two scenarios. I think we're going to be either in a 2008 scenario or a choppy sideways scenario where we see this kind of movement, but for a number of years. I think there's a pretty low likelihood that the market just takes off and we get into this bull market that all of a sudden we are, having to chase and we kind of miss the boat. The data is just not saying that that's the case. So, I think this is something that we need to continue to watch. We want to be very proactive with everybody and share what we're seeing. We hope you find value in it. Are there any more questions? I think it looks like we got to all the questions so far. So thank you for joining us. If you'd like, feel free to reach out to me directly, jim.denholm@ironbridge360.com. We're going to post this on our YouTube channel in the next couple days and on our website. If you want to follow, I do put out a little more charts and things on Twitter @denholm_Jim. So feel free to follow us, all those ways. Again, please don't hesitate to reach out directly to me with any questions, especially if you have follow-up questions after this. But I really appreciate everybody's time. I hope this was valuable, and invest wisely. Thanks, everybody.